Gold is above $5,000. Operating margins for gold producers have never been wider. And over the past 4 years, major and mid-tier miners have been acquiring gold projects at a median price of roughly $100 per resource ounce. Meanwhile, many junior gold explorers still trade at $15 to $40 per ounce of gold in the ground. Something doesn't add up. But before we can measure the gap, we need a better way to compare these transactions. Because a deal done at $1,800 gold and a deal done at $5,000 gold are not the same thing, even if the headline price per ounce looks identical. This is the problem with raw transaction prices. Every M&A headline calculates the same metric, deal value divided by total resource ounces. Simple. But that number hides a critical variable, the gold price environment at the time of the deal. When gold was $1,800, an acquirer paying $100 per ounce was buying into a specific margin profile. At $5,000 gold, that same geological asset generates fundamentally different economics. The rock hasn't moved, but the value proposition has changed dramatically. Here's why margins change everything. At $2,000 gold, with an estimated $1,300 all-in sustaining cost, a producer keeps $700 per ounce. That's a 35% operating margin. At $5,000 gold, with $1,700 AISC reflecting cost inflation, that same type of operation keeps $3,300 per ounce. A 66% margin. The margin per ounce increased nearly fivefold. From $700 to $3,300. Gold went up 2.5 times. But the margin went up almost 5 times. That is the hidden variable that raw transaction prices completely miss. And here's why we use margin specifically, not just gold price. 2 reasons. First, margin captures cost inflation. Mining costs haven't stayed flat. AISC went from roughly $1,300 to $1,700, a 30% increase. If we only adjusted for gold price, we'd overstate the improvement. Margin is the net number. Inflation is already baked in. Second, margin changes what's actually mineable. At thin margins, only the highest grade rock justifies extraction. At wide margins, cut-off grades drop, lower grade zones become economic, and the extractable resource grows. The acquirer isn't just buying the same asset at a higher price. They're buying a better asset. Margin captures that. Gold price alone does not. To normalize transactions, the formula is straightforward. Calculate the operating margin when the deal was done. Calculate today's margin. Divide today's margin by the transaction margin. That gives you the adjustment ratio. A ratio above 1 means margins have expanded. The raw price understates the true premium. Quick example. A deal done in 2022. Gold at $2,000, AISC $1,300. Operating margin 35%. Today, gold at $5,000, AISC $1,700. Margin 66%. 66 divided by 35 gives an adjustment ratio of 1.89 times. A $100 per ounce deal becomes $189. Nearly double the headline number. We applied this framework to 14 real M&A transactions from 2022 through 2026. All pre-production gold assets. All Tier 1 jurisdictions: Canada, Nevada, Australia. All source verified against public filings. Companies are anonymized here. Paid subscribers of the Gold Grid get the full breakdown with names. But the numbers are real. 2022 deals carry ratios of 2 to 3 times. A deal that looked like $100 per ounce is actually $200 to $300 in today's margin environment. 2024 deals, ratios around 1.6 to 1.9. Recent deals, ratios near 1. No adjustment needed. Now here's where it gets really interesting. Split the database in half. Era 1, 2022 through 2023, 7 deals. Median raw price roughly $103 per ounce. Era 2, 2024 through 2026, 7 deals. Median roughly $85 per ounce. Similar raw prices, right? But express them as a percentage of available operating margin and the picture changes completely. In Era 1, acquirers paid roughly 18 to 20% of operating margin per ounce. In Era 2, 4 to 8%. Gold doubled. Margins tripled. and the premium acquirers pay collapsed 70 to 80%. That is the gold gap. The gold gap index tracks this compression across our transaction database. The interactive chart is live at Gilbert Analytics, github.io/goldgap. Think of it like the PE ratio for the S&P 500. It tells you the sector is cheap relative to margins. But it doesn't tell you which stock to buy. The data also shows grade commands a premium. Assets above 5 grams per ton averaged $296 per ounce. Below 2 grams per ton, 96. A 3 times premium. But both groups experienced the same margin compression. The gold gap is not a grade phenomenon. It is a market-wide phenomenon. 3 takeaways. 1. Raw transaction prices are misleading. Always adjust for the gold price environment. 2. The compression is real. Acquirers went from 18 to 20% of operating margin per ounce down to 4 to 8%. A 70 to 80% decline. 3. Junior explorers at $15 to $40 per ounce represent a historically wide discount to demonstrated transaction values. The gap has never been wider. Next issue of the Gold Grid introduces the GA stage-adjusted valuation framework. The gold gap tells you the tide. The GSAV framework helps identify the boats. Full article with all 14 transactions is live now on the Gold Grid. Link in the description. This has been Gilbert Analytics. Independent mining intelligence. Subscribe to the Gold Grid on Substack. Follow on LinkedIn. This is not investment advice. Full disclaimer in the article.